This is my financial disclaimer so I don't get sued. Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. I'm going to be talking about the datasets, earnings, and SPY technical analysis for the week of September 8th, 2025. And I'll also be doing a quick look over Bitcoin slash MicroStrategy, Treasuries slash TLT, gold, and then finally VIX slash Volt. I appreciate everybody watching. Thank you as always, and let's get started. And getting into this week's data, and I also want to just preface this. I am working on getting a new microphone. I know my current setup sounds pretty bad, so hopefully within the next few weeks I will have a better mic. So anyway, Monday, September 8th, we have consumer credit way later in the day, so it's really not going to hit until Tuesday. But the consumer credit is expected to forecast a whole basically 3 billion above the previous amount, and each time that goes up, that's a negative thing. That's bullish for the dollar and the yields, bearish for the dollar and the yields. So or bearish for equities and treasuries anyway, excuse me. So that should be a somewhat bearish report leading into Tuesday. Now on Tuesday, September 9th, we do have the payroll benchmark numbers, and this comes out twice a year. So even though it doesn't show the implied volatility being higher than a 2-star, very likely this is going to be massive this week as the labor market is pretty much in shambles right now. I've been discussing that for quite a while, but isn't until last week that the data sets really have finally started to reflect that a lot more. Now, with that said, that data set is at 10 a.m., so 30 minutes after open. I would be prepared for that, whether you're bullish or bearish on the market. That has a lot of weight to it, and seeing how Monday doesn't have any data, this is essentially kind of the first data set besides that consumer credit later in the day on Monday. There's the EIA short-term energy outlook at 12. That's not really going to do anything. Not really interested in that at all. And then there is the 3-year note auction at 1 p.m. I am very interested in that. The current yield is at 3.669%. I'm expecting that to pull down all the way to 3.4%, potentially even 3.3. Let me quickly pull up the 2-year yield on my phone, but I believe it's pulled down massively since last week. Before I get the number up, where is it? Yeah, so the US 2-year now is currently at 3.5%. So, yeah, that's very, very low. The 3-year should be pulling down quite a bit. Now, with that said, those two data sets are going to have a lot of weight on the market, I believe, just because first off, the payrolls is a data set that comes out twice a year. It comes out in February and then it comes out in September. So it's a big deal. These revisions and everything are always a massive deal for the market. So very likely that 10 a.m. time slot on Tuesday is going to move the market quite a bit. And then again, with the yields pulling down significantly, and I'll show that later when we get to the treasury part of the video, but the yields have been absolutely just plummeting. So very likely we will see some major movement from the 3-year note auction. And the reason why we should see movement is with the yields pulling down very, very massively, it's basically signaling to the treasury market that, okay, it's time to buy treasuries again. The risk is real and we need to start putting ourselves into securities that don't have risk. And that's what US treasuries do. So now on Wednesday, September 10th, we have all the PPI data. So that is the producer price index data that's showing what the producers are doing. As you can see, the forecasts are already expecting that to pull down quite a bit compared to the 0.9% last time. They're expecting a 0.3%. I'm actually expecting cooler than that. I know that the producers have done their initial price increase, but so far I have not been seeing the further increases off of those price increases. And I do know people that work in retailer stores and or like retail stores and everything. So I talk to them quite often about the prices and if they're seeing the actual increases or not. So they have not seen the secondary increase since August. Everybody's kind of noticed that big, massive price increase mid-August, but after that, they have not seen increases from that. So this might be a little higher, this might be a little lower, but this should be pulling down regardless. Um, like I said, I personally expect that to be probably the 0.2, but very likely it will come in to what the forecast expects it to. And that's 8:30 in the morning in the pre-market. So that's going to be a very, very massive thing for the market, very likely, as the producer prices go hand in hand with um, how the CPI is, and and that's the consumer price index and just the whole labor market and everything. So the PPI kind of ties everything together. It's not the most important number, but it tells a large part of the story. Now, the crude oil inventories, I don't really care about those currently. They have been pulling up quite a bit, but they're not at a point to where they're really noteworthy. Usually if we see that getting around like the 7 million barrel mark or above, then you can expect some large price decreases in the oil industry. So, yeah, that's something to look about if you care about oil, I guess. 10-year note auction on we're at 1 p.m. Again, currently that's showing a 4.255%, but the current 10-year in the actual yields is at 4.076%. So with that said, um, we could have a very large decrease in the 10-year yield. This can go down all the way to 3.8%. And while I know some people are going to call me crazy for that, I do think that the 10-year is going to see some very, very drastic action this week. Um, we'll see. But I think that this Treasury auction could be very, very huge, as the 10-year is one of the most um, large what am I trying to say? Large dispute or largely distributed bills in terms of for sovereign nations and large institutions. So the 10-year has a ton of weight to it. If people start seeing that the yields are coming down, which they are, the 30-year yield is currently at 4.761% when it was almost at 5% just a few days ago. That's what a failing labor market will do to the treasury market and the yields. So very likely, as I said, we're going to be seeing these yields pull down very, very drastically, in my opinion. The Atlanta Fed GDP has been holding steady at a 3%. I don't believe that will hold steady. I do believe that will slowly start to pull down, but we will see. It's not a very massive market mover. Now, going into Thursday's data, we do have some of the OPEC stuff early in the morning. I don't really care about that right now, but if oil starts really dropping in price or something, then I will. But for right now, I don't care about that too much. The jobless claims data and everything, like the CPI, comes in at 8:30 a.m. So again, the continued jobless claims, we're looking at a few different things. So for the continued jobless claims, or the continuing, excuse me, we're looking for that to very, very likely start pulling upward towards the 2 million mark. And I would say probably by the end of September, we will see that occur. The initial jobless claims, the forecast says it's going to hold pretty steady. I don't believe that. I believe we're going to see the jobless claims and everything start picking up quite a bit. Now, the unemployment rate held steady last print, but I don't believe that's going to continue very, very long, holding steady. I do believe that there is going to be a large push towards the 4.8% and potentially the 5.2% in the unemployment rate. And that's not even factoring in AI taking jobs. That's just the actual economy struggling right now. We know that currently there are more people looking for positions now than are actually hiring. So that entirely shifts how businesses can hire. That means that they can pay much lower. They can choose to um, basically cut old positions and replace them with brand new hires that are willing to accept far less. It gives the company a lot more control over how they can hire instead of everybody expecting higher wages and more, basically more benefits, blah blah blah. It really shifted the scale that now the hiring control isn't in the weight of the actual person looking for the job. It's in the employer's uh, hands. So that's a little scary for the market or for the job market. That's generally what causes labor markets to end up really failing because once companies get the upper hand, that means that uh, really consumers are struggling. And if consumers are struggling that much, then they will start doing layoffs. And we know that some companies are already starting to do layoffs. Um, we're seeing closures of actual just business fronts. We're seeing all sorts of stuff happening right now. So very likely we will be seeing the jobless claims moving upward. My expectation is to be close to the 2 million point by the end of September, but we will see how fast or slow this whole process takes. Now, with that said, the CPI is expected to come in pretty much standard. There's slight expectations for increases for the CPI month over month and year over year. I don't believe that's going to be the case. Um, I think the year over year potentially could hold a little bit just because we did get that major increase and that still has to work its way through the data. But I do believe that the CPI month over month should start slowly pulling down. Now, this might be another one of these readings where the CPI is very hot because of the month of August. That's when we saw the tariffs really kick into effect. So just keep that in mind that the CPI data can come in extremely hot and it can look tricky, but we're on a whole new month. Um, that this CPI isn't for that. So just be aware of that. Now, there is the 30-year bond auction at 1 p.m. Sorry, my daughter was screaming in the other room because she's playing. Made me think off course. The 30-year bond auction is at 1 p.m. And again, the yield currently is at 4.81%. But on my end, I'm seeing it being closer to the 4.761% when you're checking the actual 30-year yield. So very likely we will see the 30-year yield pulling downward, and that really should trigger a lot more weight into the Treasury market. I do think that a lot of these data sets throughout this week really do lead to, um, a lot of money entering into Treasuries. Now, going over Friday's data, there really isn't a whole ton of important data over on Friday, except for the Michigan consumer sentiment. That's really where I think that any of this data is important. The inflation expectations, I don't really care about. Those are expectations, and um, yeah, they can expect whatever. It doesn't really say a whole lot. But the consumer sentiment and consumer expectations, that's a little different. that has a little more weight for me personally than some of these inflation readings. So I do think that the market is going to be paying attention to the Michigan consumer expectations and consumer sentiment very, very closely. And I think that very likely we will see these pull down quite a bit. A crumbling labor market is very, very scary for consumers. And once the narrative really picks up and takes off, I think that it's going to, really drag a lot of these data sets into it. It just hasn't gone to that point just yet. So again, very, very quickly going over the week. Monday, we have the consumer credit way later in the day. That's not going to affect Monday's price action. It's going to be Tuesday that really does anything for. On Tuesday at 10 a.m., we have the payroll benchmark revision data. Now, that will move the market quite a bit. Very, very important. Then we have the 3-year Treasury auction at 1 p.m. That should definitely move the market a little bit as well. Wednesday, we have the EPI data in the morning at 8:30, so just be aware of that. And then we have the 10-year Treasury auction at 1 p.m., so that's going to be a very big data set for the market. Now, again, on Thursday, we have the jobless claims and CPI data at 8:30 in the morning, and those are going to be very, very crucial for the market across the board. And then at 1 p.m., we have the 30-year bond auction, which again, I do believe that's going to be very impactful on the market as well. On Friday, uh, basically all the data comes out at 10 a.m., so 30 minutes after open. And then after that, really nothing important is being released to move the market. The WASDE report doesn't really move the market at all, and either does the US Baker Hughes oil rig count. So yeah, that's the data. And getting into the earnings, as you can see, there really isn't anything important this week. There's Oracle, and Adobe, but that's really it. I know a lot of people are looking at GME just because it's, the big meme out there to trade, but I don't really care about that one too much. Now, Kroger, I'm interested in reading over their earnings just because I'm interested in hearing about consumer weakness. But overall, we have Oracle and Adobe. Either one of those failing or doing great aren't really going to move the market a whole lot. Um, Oracle, if anything, would be the one to move the market, but I really don't think anything Oracle's going to be producing in this earnings report is going to massively shift the market. So really not a whole lot on the earnings front this week. If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime. Getting into the technical analysis, as always, let's make sure our daily time frame is set on, our Bollingers and our moving averages are turned on. And let's get into it. So the market closed at 647.24 on Friday, and the 5-month is currently at 645.08, so essentially right at 645. With the market closing at 647.24, very likely we will see the 5-month pulling upward up to basically that 645.50-ish range. It could pull up to the 646 range, but it really depends on the pre-market if, a lot of this upside is holding or not. Currently, the overnight's at 648. So we're just going to base the 5-month off of the 645.50, which means the upper bounds is at 647.50 and the lower bounds is at 643.50. Okay. Let me just open this a little bit bigger so it's easier to see. Now, with that said, the Tenma is currently at 645.30, excuse me, 645.39, and it will pull up very slightly. So basically, the 5 Ma and the 10 Ma are going to be right on top of each other again. The 20 Ma is at 642.99. It will be pulling up very, very slightly. So we're basically going to call it 643. The moving averages are still fairly consolidated here, but they're positioning in a way to head bullish if they want to, but I'm going to discuss why that may not occur. The upper Bollinger is currently at 651.03, and we have had the day one upper Bollinger already occur. So assuming Monday has the day two upper Bollinger move, we should expect a higher high. And from that higher high, we should expect a slow downward consolidation. Okay, so that's kind of why I was saying, even though the moving averages are positioning in a way to where we can head bullish, potentially because we had that upper day or that upper Bollinger day one already occur, this can pull upward and then start pulling downward all within the same session to where the 5 Ma could actually head downward again, potentially. So just keep that in mind. Now, the lower Bollinger is at 634.94. It will be pulling up slightly. If we continue seeing buying, then it will be pulling up towards that 640 range, which really means that we're really seeing everything just stuck together, heavily consolidated, which means that a very large move is going to be occurring very soon here. Apologize for sounding so tired tonight, by the way. I haven't had the best weekend. Anyway, so just going over the Bollingers and the moving averages, based off of where everything is right now, either one, we should see that higher high of the day two upper Bollinger and then have a pullback into the 5 Ma. However, Friday was kind of a weird selling day, and let's go over just the hourly chart to show that. Friday we pulled downward quite a bit, which was weird because we actually secured that all-time high at the 652.21, and then we pulled all the way down to what was it, 643.33. So very weird kind of session there. But with that said, we should still expect the higher high of the day two and the consolidation downward. But again, everything is very, very closed off up here. So with the 5 Ma basically being at that 647.50 range, potentially even the 648, that means currently the market's within the 5 Ma and the upper Bollinger is at the 651, so that's basically going to pull up very slightly. It might even pull down just because we had selling on Friday. So everything's getting really, really compacted up here. What it really tells me is that I do believe we will be seeing a sell-off into the lower Bollinger pretty soon here. And the reason why is just because it's really closing off our upside. Unless the market pulls down, retests the 5 Ma, from the 5 Ma heads down to the 20 Ma, does a 20 Ma test, from the 20 Ma heads back to the 5 Ma, and basically while testing all those moving averages, it reopens the upper Bollinger again, back up to the upside, which then allows the market to build liquidity to head back up. Currently, we're overextended, and I'm not saying that through like RSI or anything, just through using our standard Bollinger and moving average mechanics. We have seen a few 20 Ma tests, and they haven't been very deep tests, and I've talked about this, but generally I'm looking for a 20 Ma test to be about 2 to 3 days. And while we are seeing candles showing 2 days of price action, it hasn't been 2 full days of price action at that level at all. They've just been very quick moves down and then buy all the way back up, move down, buy up, move down, buy up. And I even discussed this last week before all this buying even occurred. I said, this has been a very, very consistent pattern of where we just sell down to the 20 mo, buy up, sell down, buy up, sell down, got down to that range, pulled back up, and then we sold back down. And I believe that was near that Friday when I mentioned that, but I said very likely we're going to see the market basically buy this entire wave back up and then head back down, which we did get that. And from that downside, would very likely head all the way back up. We're going to continue seeing that until this breaks. Okay. And how do we know it's going to break? Because we're seeing the room between each 20 mod test start to shrink. Original 20 mod test back at 425. Then there was a very, very, very slight one at 523. The next one from there was at 623, so a whole month between the 20 mod there. And it was just a very, very slight 20 mod test. It was only there for, I believe, an hour and a half, if I remember correctly. And then we didn't see the 20 mod again until 801. And then again, from 801, we saw it 820 and 821. And then from 820 and 821, we now see it 902. So we're starting to see the frequency between the 20 mod test start to pick up, which is starting to tell us that more selling is occurring. That is the simplest way to see it, is simply more selling is occurring. And we know that's occurring too because the price action has been very, very slow. Once we hit that basically 620 range, it's been very, very slow heading upward to the 650. And even though it's occurred over the course of 2.5 months, it has been slow for those who have been trading this price action. I mean, compared to seeing how the actual correction was bought up and some of the buying days within those sessions, the prices slowed down a lot. Okay, it's actually become somewhat of a normal market again, other than the fact that we haven't seen the downside test. That's what I'm looking for. I'm looking for the downside test, and I'm still positioning to do so each time we head into the upper Bollinger. Again, upper Bollinger day 2 is when you short. Each time we do that, even though it's been very, very hard to short this upside, they have been successful once we've realized that we have to start taking profit a lot at that 20 mile range and repositioning from there. But once we did that, we've been seeing a lot more success in shorting this crazy rally. Okay. Um, I'm still going to be shorting each time we get to the upper Bollinger day 2 because that's just the mechanic I trade with, and eventually this will pull down and start selling. Now, with that said, I just want to pull up the drawings very, very quickly. And that's kind of a mess, but we're going to go over it really quick. So this is probably on the 4-hour time frame. All right, and that's what we were discussing. Okay, so yeah, this is how I was discussing last week, how we had those large buy up, sell down, buy up, sell down, buy up, sell down. And basically it happens at the 20 ma each time. Now, we barely struck the 20 ma in this last buy up, but it did occur. Now, from this, we should expect, if I can find the drawing tool, hold on. We should expect essentially this to be bought right up to that level, maybe slightly above, and from that level, start to sell down again. Now you can see the actual frequency between these buys and sells are starting to slow down. They're starting to get smaller and smaller and smaller each time. So very likely this is trying to tell us that the buying is tapering out. The selling is eventually going to head downward and, basically start closing some of these gaps to the downside. Now, with that said, just very quickly going over structure here. Sorry, my daughter's running around. So, for the bullish upside, potentially, we have the cup formed here. From the cup, you just need to look for a handle. That handle could be much larger, it can be much smaller, but you need to just look for bullish structure at the bottom. Potentially this could be pretty bullish structure. It doesn't look like it on the 4-hour time frame, but on the hourly time frame, all you need this is to close that range back up to the 652. And then again, you have another bullish cup. From that bullish cup, you form a small handle and head upward. Okay. So really for the bulls, you have everything you want. You just need to take calls and allow that upper Bollinger Day to higher high to occur because the market is definitely kind of pushed in that direction. It looks like they want to head for that. But with that said, discussing the bearish thesis here is that potentially we do have a head and shoulders starting to form here, even though it's wonky, but not every head and shoulders has to be perfect. And from that head and shoulders, if that completes, then we can start to see the inverse cup take some of this liquidity to the downside. And from that inverse cup, we should expect a bounce at the bottom. From that bounce, build more liquidity to head down and take that liquidity gap in the red box. So that's what the bears should kind of expect from here is, again, look for bearish structure. Once you see the bearish structure, we are in the upper Bollinger. We technically are within the upper Bollinger Day 2. Whether we actually get the higher high or not is, to be determined. But assuming we don't, it's still a good short because what's below us? The 5 mile, okay? And what's below the 5 mile? The 10 mile and 5 mile are essentially right at the same level. So if we do head downward, we're going to head downward towards that 20 mile again. And if we close downward, then we are going to see the 5 mile pull downward as well. So a lot of interesting structure here on the 4-hour time frame, and you could follow on the hourly time frame. I suggest that. But again, you're really looking for bearish structure to head downward. So far, we see a ton of bullish structure. Unless this bullish structure is invalidated, we should really expect to head upward. And from that heading upward, we should then look for a bearish structure in the top region. And that would be where you would then short. Okay, because again, upper Bollinger Day 2 is the day to short. Whether you get your level or not, it's still technically the day to short. So it's hard to determine whether the market looks overly bullish or bearish right now. I do have to say this bullish structure looks really good. I'd be very surprised if they don't take the 652 and probably push it to the 654. I'd be very surprised if they don't do that. But I do know that the labor market data on Friday was just atrocious, and potentially that can cause some real selling. So we'll see about that on the SPY. And taking a quick look over Bitcoin, let's see. So just before we even go over the actual chart, we know that MicroStrategy did not get into the S&P on Friday. That doesn't mean that they won't get their shot at getting into the S&P. That just means this cycle they're not getting included. I believe it was Robinhood and oh geez, I don't remember who else it was, but it was Robinhood and someone else. But overall, looking at Bitcoin, there's two different structures that we really have to determine here. Okay. Either one, and this is again the daily time frame. just so that everybody's clear, is that one, we're going to close this cup upward towards the 124, excuse me, 124,000 range. If not, then we are going to start heading this or forming this shoulder to the downside. Okay, and again, that downside takes us all the way to the 98.1. With that said, however, we do have some major bullish structure here within the hourly time frame. We do have a very nice inverse head and shoulders formed here. We are at a very, very key bottom support range. Excuse me, I'm losing my voice. So if the market wants to, this inverse head and shoulders can break out to the upside, fill that 113.4 very, very quickly. And from there, that would actually fill out this larger cup. From that larger cup, that would fill out a large portion of this inverse head and shoulders. And all it would take from that point is a small handle to break out. That would form a cup all the way to the 117.4 thousand. And from there, again, just continue building these cups all the way up to, essentially all-time highs again. Now, this is going to matter and kind of work in tandem with the rest of the market. If we see the rest of the market kind of selling off, I do really expect Bitcoin to follow that. And just doing a quick look over the dollar, just a reminder that Bitcoin and the DXY used to have an inverse relationship where if the dollar was moving up, we'd be seeing Bitcoin moving down. If we saw the dollar moving down, we'd be seeing Bitcoin moving up. Now, those don't always correlate anymore as much as they used to, but it does still take considerable weight out of Bitcoin when the dollar heads up. Now, there is some very bullish structure here. Okay. We do have, I'm so surprised that held. I have not drawn on this chart in years. Okay. So that's interesting. That selling channel is held probably for a year and a half now. Super interesting. Okay. With that said, we do have this very large inverse head and shoulders forming here. And from that, we should start seeing some of these cups closing. Now, if the dollar is going to continue heading downward, which we have a lot of pressure from the Treasury, the Fed, and just kind of everybody to pull the dollar down, we will see this inverse cup close to the downside, invalidate the bullish structure, and then continue down this major selling channel. Okay. Quickly looking over MicroStrategy, just on the daily time frame, I want to pull up the Bollingers because it is probably going to be a buy. Okay, so assuming, depending on how far down MicroStrategy actually gets here. Now again, there's a massive gap. It can take this entire gap down to the 238 if it really, really wants to. I don't think it's going to, but again, we have the lower Bollinger at 307.91, so that should be telling you that if they're going to push that lower Bollinger, and let's just look at the 5 mile, all of our supports are massively above us, so excuse me, if they want to take the lower Bollinger, then they're going to have to drop this a whole basically $30. Okay, so the downside is $30. And where's our upside? Well, our 5 mile is currently at the 333.95. It will pull up actually because the market closed at 335.87. So that's going to be pulling up to the 334.50-ish range. That gives our upside right now basically $12, assuming they just go straight for the 5 mile. And with the 5 mile being so far below the 20 mile, and again, this is in bearish territory. MicroStrategy has been in very bearish territory for a while now. When the 5 mile is below the 20 mile, that's when you know that the selling is really going to continue, and it's been holding that way since late June, it looks like. So again, either they're going to push this down a whole $30, hit that lower Bollinger, and from that lower Bollinger, that's going to be a super, super, super good buying area, or they're just simply going to buy up the 5 mile and start closing some of these gaps to the upside. I do think that there's a good case for either side, so just be a little cautious of that. And going over treasuries, we're going to start with TLT because TLT is kind of in an interesting spot. So TLT is pushing the upper Bollinger, and again, just like every upper Bollinger, we're expecting a day 2 higher high. Now, let's see what gaps we got going on. We have closed this gap here. Oh geez, I'm going to hide all those drawings. Even though they're playing out really well, we got the cup closed, we have the handle closed. From that handle, we should expect another handle upward. Okay, that's great. I'm gonna delete that and I'm gonna hide the drawings. So short term, expect a higher high into a very small downside. But the upside is massive. Okay, absolutely massive. Um, Again, I believe we're exiting the Treasury bear market, and if that's true, then TLT is going to be heading basically above the 100 range again. It's going to be heading, it generally trades around that 114 area, give or take. So potentially, we can see some very, very large upside within TLT. But we should expect a very small downside just because of the upper Bollinger mechanics. With that said, I do want to very quickly look at the US 10-year and what's going on there. Okay. It has broken a very, very, very strong level of support. Okay, and this support goes all the way back to the end of April. Now, this is starting to pull down to the early April level of the 3.97. I do believe that this week or next week we will see that level challenged again. And the reason why I do believe that is because we have a lot of treasury auctions this week. We just had the labor market essentially come out saying that it's failing. All of these yields are going to be pulling down massively. Let's take a look at the 30-year yield. Massive downside. Massive downside. I mean, huge downside. People were worried that we were going to see it pulling to all-time highs. And funny how that changes so quickly. Yeah, the 30-year yield is telling us that it wants down. The 2-year yield is telling us it wants down. It's starting to break some massive levels. Let's see. It's actually the lowest it's been since 2022. That's very impressive. Okay, now who pays attention to the US 2-year yield? The Fed. What is the US 2-year yield really go hand in hand with? The federal funds rate. Now, the federal funds rate is not at 3.5%. It's not heading down currently to 3.4% or lower. So very likely we're going to see the interest rates following very close to a lot of these treasury. I mean, look at this. This is even the 1 year. It is just pulling down massively. 10-year. Again, this is a 5-year chart. It's really starting to pull down to some of these lower levels. Now, again, the 10-year does have some work to do. the lowest level it was back in 2023. And then there was that um, period during September 2024 that it was starting to pull down very quickly. But very likely we're going to see that level challenged very, very soon. And that was what, the 3.6? Yeah, very likely we're going to see that challenged very soon. So that's kind of my thesis on treasuries. I do expect a lot of downside within the yields. I do expect a lot of upside within TLT. However, again, cautious as always is that when the Fed starts the rate cut cycle again, almost always for 1 to 3 months after, the yields go back up. I don't know why that is. I don't know if it's short positions closing. I don't know exactly what triggers that specific mechanic, but almost all the yields pull back up. So what that means is that during that time, you could actually short TLT for quite a bit. I shorted TLT the last time that happened from I believe it was this, yeah, it was this 97. I shorted it right at like the 97.02 all the way down to this 80. I will close my short at 84 something. It was right in this range, right in there at the low of that one. I didn't expect it to continue heading back down, right? That was the bottom Bollinger, so I figured, that was the end. But it headed down a little bit more. What I'm trying to say is there's a ton of upside, but when the yield or when the rate cuts start, there can potentially be a ton of downside. And we haven't seen the type of upside to really warrant the type of downside, so this cycle might be a little different. But I'm just throwing that out there that it can happen. It's happened in the past. It's, you know, a thing that occurs very often. Now, again, just quickly going over gold and silver. This is the actual gold ETF. Sorry if you can hear my daughter screaming. She's disagreeing with my wife right now. Okay. So gold. Gold kind of decided to make me really upset here. Anyway. So we had the upper Bollinger push. We had the day 2 higher high. I shorted that. We pulled down, and I do believe we pulled down into the 5 mile. It was basically right above it. So it didn't pull right into the 5 mile, but it pulled almost right into it. And the market used that as a point to bounce. So my gold shorts aren't the happiest. However, that does mean that tomorrow we should assume we should get a higher high within gold. And from that higher high, I will be shorting again to the 20 mile. Currently the 20 mile is at 313.57. I'm realistically looking closer to that 317, 320 range, but there's a lot of downside. So I am looking for it. I do think we will get it. And just going over the GC main, same thing here. We did not get the, oh no, yes we did. We did get the extended upper Bollinger move. It's not showing in this candle because this candle is obviously today's session and today's session hasn't finished. So you can still get that upper Bollinger higher high day 2. Now in silver, I have been shorting silver. I did close a major position when we did hit that 5 mile range back at the 660, or not six, the 36 74 is when I closed the majority of my puts. Now I do still have a few, and when we pulled up on Friday, I did buy a couple more. We should expect the day 2 higher high. If we get the day 2 higher high, obviously I'm going to take more puts. I'm looking for the downside. The 20 mile is currently at that 35.28. I'm realistically just targeting the low side of the 36. That's going to be a massive profit. When I did the move from the upper 37 down to the 36.74, I made, I think it was what, $31 or $32 per contract. and those were very cheap contracts. I had a ton of them. So that was a really nice trade. It didn't go as deep as I wanted it to at the time, but that doesn't mean it's over. I'm still looking for that much deeper short. Okay. And finally, just going over vol slash VIX. This is UVIX, so this is the ×2 long V or VIX ETF. We've been getting absolutely destroyed on it. I'll be honest. We were buying into this way back at the $18 range essentially, when it was right in here. We've been slowly DCing our position down. I know that some people are still holding an average of like 19, 18. Some people are having a very good average of this $11, $12 range. It doesn't really matter what your average is in here. What you do need to be aware of is as long as this isn't going to reverse split, your position is fine. If you believe in the correction slash sell-off anyway. That's why you're holding this. So it doesn't matter if you're down a few dollars a share right now. That's not the point of what volatility does. Volatility is a very large and quick pop upward when people actually press the sell button. We have not seen that yet. We've seen a very few times where we've seen very minor positions of selling, but we have not seen actual selling occur. This keeps me holding UVIX. Okay, that's the reason why I've been continuing to hold such bearishness overall, is because we have not seen the selling. We have not seen the reaction that would suggest we're seeing the selling. We had, this is the VIX volatility chart. Now, we've had a couple pops up to the 115, 120 range, but we have not had anything that's held for very long. It's been like a single day, and then it comes back down to that 90-something range. Remember, as long as this holds above the 98, that's when people are actually starting to buy VIX and sell positions. But we really need to see more continuation within the VIX volatility. I'm not expecting some massive, 190 candle like they got during the major correction, but I am expecting something that's holding longer. I'm not just expecting a single day pop and then head back down. We're looking for actual selling to occur, and we have not seen that since basically the previous correction back in February through April. So that's what I'm looking for in the bear positions. And again, just very quickly looking at the SPY. That's why we have bearish positions in the SPY too. We've had this major cup and it's been overextended. We're looking for this to pull down and form a handle on this major cup. Okay, we're looking for a major support test of the lower Bollinger, which we have not had since back in early April. Okay, so that's not normal, and that's what we're looking for. We're looking for just a standard support test of the lower Bollinger. We have not gotten that yet. So until we do, until we see some actual selling, I will be pretty bearish. I will still hold this we are overextended thesis. Um, you know, we're seeing a lot of weight in the treasury market starting to open back up again to where the treasury market might end up into the bull market again. So there's a lot of reasons why I don't see tech heading up too far from here. I'd be very surprised, but with that said, we do have to keep in mind that unless the narrative changes to where rate cuts aren't bullish, because everyone right now thinks that rate cuts are bullish and they're not. So very likely if we get like the negative 0.5% rate cut, for example, that will change the thesis from, oh, rate cuts are bullish to, oh, rate cuts are being done because, the economy is actually failing. Um, that will shift a lot of this upward buying pressure. Remember, we only got this correction out of tariffs. Now we have the answer to all the tariffs and everything, but what happens when we have our labor market start to fail, which we already have signs of? What happens when people decide to take a lot of this weight and put it into TLT or, treasuries again? Um, there's a lot of money up here that is just being waiting to be taken. And I do believe the sell-off is coming. Due to the many different signals I've mentioned. So with that said, I know tonight's video was long, I apologize, but there was a lot to cover. I hope everyone has a great week. If you have any comments or questions or anything about the video, feel free to leave them in the chat. I'd love to discuss with you guys in there. But yeah, have a great week. Have a great trading day tomorrow. And I will talk to you in tomorrow's video. Take care, everybody.